right, I'm Michael, and this is Timothy, and we're here to talk
Michael.
today about self-invested pensions. So, Tim, I'll jump over to you with the first question. Why did you decide to take up or set up a self-directed or self-invested pension?
Yeah, it's a good start. I mean, it wasn't entirely up to me. I was with my employer at the time, and they asked me what they wanted me to do with their contribution to my pension, and they didn't have a default option to put it into. So at the time, I just asked the manager that I had at the time what he did, and he managed his own. So that's what I ended up doing. That's the honest answer. And the reason I stuck with it, I suppose, is because I liked the idea of being in control of what's going on. And I think with your pension, even if you do outsource it to somebody else to manage, it's still your responsibility to manage it. And I liked the idea of having as much control as I wanted over that. And I think within a self-managed pension, you can look at as much detail as you want, or you can effectively mirror something that's not self-managed by just putting it into a couple of funds, or you can take advice if you wanted to. But really, you have all the options there within that to do what you like, and that appealed to me. I take it that I have my responsibility to my pension, whether I like it or not. So I wanted to have some control over that.
Yeah, excellent. I like how you kind of accidentally stumbled across it but managed to stick to it, which is really, really good. I know for me, it was a case where I know here in Ireland, often the not always sure about the fees and what's actually being charged, and sometimes when you've got a pension, when it's you don't always get to see what the fees are. I kind of feel like, how much are they taking? So
absolutely, I think transparency is really key, and I think the times that I have looked around to see, well, maybe I could just put it into something else and not have to worry about it. It's actually quite hard to understand what's going on, and what fees do you really pay? What is it really being invested in? It can be quite hard to to really drill down and see what's happening. And within it was much easier if you just do it yourself.
Exactly, and then at least when fees are charged, you can see what they are, and you can work out what they are, and you can ask questions if you're not happy. So for me, that was definitely the first reason why I wanted to do it. And the second reason was because I wanted to get access to some of the funds which I feel like are the benchmarks. So, for example, a lot of the time we compare our returns to, say, the S&P 500, and I was always annoyed that I didn't feel like I was always getting those returns. And I know there's fees and exchange rates to take into account, but I still sometimes felt like I was a little bit behind on those. So I felt like if I could at least invest in some of those funds, the Vanguard funds and so on, that at least I would know that I'm getting the best possible return without, again, back to that transparency, knowing that I know what the fees are when they are paid.
Yeah, absolutely. Yeah.
So the next question there that we want to ask is, what lessons have we learnt? And I guess this could be rephrased as, what mistakes have we made? But it's nice to think that at least we've learned something from it, hopefully.
I find you learn a lot more from your mistakes than you do from your success.
Well, exactly. There's always that saying, you learn more from your losses than your wins. So yeah, I mean, is there anything in particular that you've had to learn the hard way?
Yeah, definitely. I mean, there's a few things that I could say around that. I mean, I think the first thing is how much time you put into your pension. I think if you're self-managing your pension and you're interested in it, you can end up maybe spending a bit too much time on it. And I think you have to remember that the point of your pension is that it's supposed to work for you and not vice versa. And I think you can easily, especially if you are getting interested in investing in particular stocks or ideas, I think you can end up, treating it almost as a part-time job on the side. And I think actually, you don't really, you need to pay attention to it, but you don't really want to put all of your time into it. And I think there are certain sorts of investments, if you're interested in investing, that you might make, and I try to exclude those from my pension itself. So for pension, I try to only put things in there that I'm happy to hold for the long term. So I'm not trying to do things where I'm speculating on something, or whether I think something is going to happen, so I'm going to buy something and then wait for it to happen and then sell it. And I think, and part of that reason is because, I get, most people will have a full-time job, might have family, and might have lots of other calls on their time. And just because one month you've got lots of time to think about your pension doesn't mean the next month you're going to have lots of time to think of your pension. And so I think you have to be a bit disciplined about your time, not putting too, you have to put some in, but also don't put in too much just because you've got a bit of spare time. Because then you easily end up making mistakes. And I've done that where I've, I might have invested in something, it's done well, but then I've sort of forgotten about it. And the only reason, the reason I invested it has come and gone. And a year later, it's kind of it's petered out a bit, and it's not being the investment I thought it was. So you end up, I guess, you can end up with a bit of mission creep, I guess, on particular investments. One way to put it.
Yeah,
go on.
Point. I think that's a great point, and I think it's worth reminding ourselves as well that when we're investing in a pension, we're investing very much for the long run, decades time for most of us. So when we take that sort of horizon, it allows us to see maybe a little bit clearer, and sometimes that's good as well because it removes a lot of that emotion that might come from investing for a very short term or speculation, as you mentioned. So I think that's a great point.
Yeah, and I mean another point on that is when you start your pension, relative to its hopeful ending value, the amounts in that pension are pretty small, even if they might seem significant to you at the time where you are in life. And I think you do sort of have to think about when you put time into, if you're managing your pension, you put time into putting a particular amount of your pension into a fund or into a particular stock. You have to weigh whether you're putting enough into that. And I think if you have to remember that you can't touch that pension money, probably for 20, 30 years, depending on what age you are and you're investing it. And you're putting a relatively small amount into an investment, ultimately might not have been worth your while. And so I think, you should keep a fairly concentrated number of investments in there. And then I think they should all be appropriately weighted. And if you're not happy to put a decent amount of your pension into a particular investment, then maybe it's not the investment you should be making in your pension at all. I think is definitely guilty of that. Of investing in something that I thought was great, but didn't really want to take too much risk. And it did well, maybe, but ultimately it hasn't really had an impact on what my pension is worth in the long run. So I think again that's a kind of a time management issue as well. How much you're getting out of your pension.
Yeah, and I guess for me, on some of the mistakes that I've made would actually be, and similar to what you touched on when you mentioned not putting enough in, it's certainly been that case where I've probably haven't put enough into the pension and invested too much personally where I should have invested in a pension. Because sometimes when you go for those short speculations, they ended up not working, or they're a complete disaster and you lose everything. Whereas at least a pension, you're putting it into regulated funds a lot of the time and things that are that are going to stand the test of time. So I think a lot of the time we feel rushed and we feel like we need to catch up for whatever reason. And the truth is, when you take a long run view of investing, that it's a much healthier way to kind of invest. And that comes back to that question of when are you going to need to rely on this capital? And for most of us, when we look at it properly, it's probably going to be in retirement. So what good is investing in something before then when we don't necessarily need to have access to it until retirement anyway?
I was going to say something else. So the other side of that is holding. What a mistake I've definitely made is holding too much cash in my pension, because you're worried about, well, it's now the right time to invest in the market. Maybe I should hold up for a few months, and then again, it's another time point. Are you really going to be paying enough attention in a few months' time to make that big call? And again, if you're working and you're contributing regularly to your pension, you should really be investing regularly as well. So you have to have that discipline of looking at it, whether it's monthly or quarterly or even every 6 months or 12 months, and making sure that you are putting your contributions to work, because otherwise it's just sitting there earning nothing. And if you are regularly contributing to your pension, then you shouldn't worry too much about market timing, as long as you're making investments regularly. That will add up over time, and some of those you will have put the money in at a slightly high point in the market, and others you will have put them in at a slightly low point in the market, and it's going to balance out. And over 20 to 30 years, you're not going to really notice that much, as long as you're disciplined enough to be just doing it regularly. I think that's far more important than trying to time something.
Yeah, I've definitely been guilty of that one as myself, Tim. So I was sitting on a lot of cash at the start of the year, hoping or thinking there might be some sort of correction, and it wasn't actually until I was in a supermarket one day and I looked around and I could see everybody buying everything, and I thought, well, this is madness. Why am I holding cash when clearly the economy is going to go nuts when everything opens up? So I ended up putting money in, but I probably lost a good 5% of holding on to cash. And at the moment, cash is actually costing you money in terms of you're losing. We've got negative interest rates. So there's no real return. So yeah, I've definitely suffered from that as well.
Yeah. And I mean, there's all the usual kind of investment, getting over emotional about your particular investments and things. So I think really just concentrating on the fact that this is, 20, 30 years, maybe more, if you're lucky enough to start young, time horizon for you. And so you don't worry too much about what's going to happen the next year or two, and just keep plugging away at it. But bear in mind that it's supposed to be looking after you, and not too much vice versa.
Yeah, brilliant, excellent. Okay, let's jump over to question 3 then. So we asked before about what wasn't so good, but what have you done well, and what have you been really happy with, and maybe has exceeded your expectations around some of the investments that you've made or some of the processes that you've had with the pension?
Yeah, so again, it's just trying to think long term about your investments rather than trying to think what's going to happen in the next 6 months or 12 months. And it's about what I've found rewarding is investing in maybe in particular. So I do a bit of my pension is a mix of individual stocks and some funds. But what I'm always trying to do is just think about the long term and what are the long term maybe structural changes in the economy, and how can I invest to succeed on the back of that. And sometimes, I mean, having just said don't worry too much about timing, but sometimes you can see something happen in the market, maybe with a particular stock that or a company you think that's, although there might be a short-term problem, that company or that fund is absolutely in the right long-term place. So one particular company that has done well on that kind of theme was an Irish company called Icon PLC, who basically the major pharmaceutical companies and small biotechs outsource basically testing to Icon and other companies. And this is an area of it was and is an area of big structural growth. And Icon went through a difficult phase for a few months around what was happening with some of its customers. But really, it was still on that long-term trajectory of growing. You could see that there was a lot of interest in biotechs who were never going to have the scale to do their own testing. Big pharma companies don't want to do their own testing for various reasons. And that proved to be a really good time to invest in that company, which then went on to outperform, over a few years. But so it's that kind of identifying the long-term themes, and you could talk about that with e-commerce and just investing in Amazon and or companies like that, or the growth of the internet, companies like Facebook or Google, perhaps. But I think it's what I find rewarding is to find something maybe slightly unusual, where for whatever reason I know a little bit about the company, and you can see a kind of a long-term trend, or a fund when you think. So for a long time, Japan was a very poor market to invest in, and there was definitely a point a few years ago where it became a bit more interesting. I didn't really want to do that myself in terms of picking stocks, but I found a couple of good funds to invest in, and they did spectacularly well for a few years, and are still doing very well. It's that kind of identifying a long-term trend where you think either something is going to change, or just the market hasn't caught up with something yet.
Yeah, very good. I know for myself, I think I've done particularly well over the last couple of years in some of the IT funds and shares and stuff like that. So that's been particularly good, and I've been fairly bullish on them. Obviously, with COVID-19 happening, that in the end was a good bet to have. I guess something of interest is like, a lot of the time you hear things like, oh, but the share market's at a record high at the moment. And the funny thing is, I started my.
It's meant to be though.
yeah.
Well, the idea.
I mean, I started my pension and my first contribution at the end of 2017, and every year that I would talk to somebody about my pension and investing, I would get the same thing. But it's at a record high at the moment. Bar the drop in March 2020, it was always the kind of, and the small drop I think at the end of 2018, it was always the same thing. It was always, but it's too high. And so there's definitely exactly as you said, Tim, to try and ignore that noise a little bit and take that long-term view. So I guess in many ways, when I look at success, I had a lot of friends when when March 2020 hit. COVID-19 was probably at its worst in terms of impact on the share market, that was selling out of funds and selling back to cash out of fear. Whereas even though my work situation wasn't guaranteed at the time, I still actually upped my contributions then,
Yeah.
which kind of went against the popular grain. And these things are funny because when you look back, it was like, oh yeah, why wouldn't you do that? But at the time, you're actually fearful of, should I be putting this money into a pension when I may not have enough money to feed the family next month? So there's always a little bit of balancing act. But I was proud of myself for seeing that through. When the market kind of collapsed there for a few months, I wasn't checking the pension at all. I actually stayed off checking it. I knew it was going to be bad, so I wasn't going to look. I tend to wait for the news that, oh, it's up. You might hear a news article on record highs and so on. Then I log in and check the pension so that I feel happy when I look at, not worried about it. And
not worried.
So again, a lot of that was around surviving those crashes. And I think in many ways, and this might sound strange, but a crash now for most of us would be the best thing that could happen, because it allows us to buy more units of a fund for a lot less, and would allow us in the long term that would be beneficial. Whereas, of course, as humans, we want to see it go up, but in fact, it's not always the best thing for us. And learning to ride those crashes out is going to be part of it. And for most of us, assuming that our pension is going to be in play, a part of our life for 60 odd years, for a lot of us, there's going to be a lot of crashes and a lot of corrections happening. So the sooner that we get used to riding them out and not going and hitting the sell button, because I think that's one of the things with a self-invested pension, is it's easier for us just to go and sell out of that fund if we have to. Whereas if it's managed, we have to probably pick up a phone and talk to somebody. But with this, we can just log in, click sell, and away it goes. So making sure that we have those emotions in check and understanding that corrections and crashes are part of the cycle, and being able to take opportunities when that happens. And I'm certainly excited about the next crash. I know that sounds strange, but every time I survive one, I get more excited about the next one, because I know that there's going to be opportunities. And when you're hearing that people are selling, then that's a really good thing, because it means there's opportunities for you to be buying at that point. And again, when we take a long-term view, it gives us a long-term horizon, so we're not going to be worried too much about short-term noise.
Yeah, no, absolutely. And well done for making that extra contribution as well. I mean, it's one thing to hold your nerve, but it's another thing to put more in. But absolutely, and again, the advantage.
It's funny that you say that, because I would have loved to have, hindsight's 20/20. But if I could have put every squeeze even more, and I would have, that's always the ironic thing when you look back. So.
And again, the pension structure should really help you make those, kind of keep those emotions in check, because, you're thinking about it, well, in 20 years, I don't even need to draw anything from this for 20 years. So should I really cash everything out now? How is that? If the stock market doesn't rise from its current level over the next 20 years, something has gone a lot very wrong in the economy, right? So you probably have a lot more to worry about than whether what the value of your pension is.
Exactly, and it's really interesting you say that, because I hear that argument a lot. I really do. Oh, but you're investing and you could lose it all and so on. It's like exactly that. There's going to be bigger things to worry about than our pension. That actually happens.
Your Vanguard S&P 500 ETF does nothing for you over the next 20 years. It will be a very different scenario to the one you're thinking about.
Yeah, and ironically, like even if it's a scenario where, let's say, it dropped for half and it spent 10 years below there and then slowly built up to where it is today, with cost averaging, we're still going to be up anyway.
But so you're still contributing, if you're contributing every month or every few months or every year, whatever it is, and you're just gradually cost indexing, then you're away. And don't worry too much about what's in there at the moment.
Exactly. And then you've got all the dividends and all of that on top of that. I mean, there is that saying that time in the market is better than timing the market, and I think that's certainly something which I've seen firsthand. I'm definitely no expert at this stuff, and it's just been a process for me of investing consistently every month and making sure that I continue to increase contributions rather than decrease contributions. Excellent. Look, we've got one last question to wrap up on, which is what type of assets or funds do you look to invest in? So I know you've mentioned one already about the pharmaceutical testing, but if you were asked kind of what are some of the things that you like to try and make sure that exist in what you invest in, what would you be covering?
Yeah, so I suppose I invest in a mix of things. So as I said, my pension portfolio is a mix of individual stocks and some funds, but those are almost entirely equity based. So they're shares in companies, whether there's a fund in between myself and them, or I've done it directly. So I have a couple of very small holdings in kind of high yield bond type investments, but and a bit of cash, which I just, every once in a while I invest some of that cash, as we said. But yeah, so I try, I try not to have too many bond holdings in there. I try not to have too many small cap type investments in there, unless it's through a fund that I'm really happy with that fund for whatever reason. I do have a couple of funds like that as one, and they tend to be geographically focused. So in terms of sectors, I guess it's a bit of a, I'll be honest, it is a little bit of a mishmash. So it's sectors I'm happy with, or with the price I'm paying for whatever it is. So there might be some real estate, a couple of real estate funds in there, which I just have just because they pay nice dividends, and I think the price is all right, and I'm not going to worry about it. And then I've got maybe some more interesting things where they're invested in maybe tech stocks or particular parts of the world like Japan. But in general, I tend to avoid things that I think I might have to worry about. So that might include individual investments in a small cap stock, which that could do very well with you, and there's good cases for investing in those sorts of things. But I think I try not to put it in my pension. And equally, I'm still a while away from having to rely on my pension for any kind of income or take any kind of drawdown from it. So I think there's very little advantage in the current environment to be investing in bonds. I have a little bit in there so that I can sell them and buy some equity if there's an interesting time in the market, but I don't want to have cash in there. So kind of a small amount of kind of cash replacement type things. But otherwise, yeah, so it's a bit of a mishmash, I guess. In terms of geographies, tends to be a mix of I've got some US things in there and some developed Asia more than developing Asia, and a little bit of Europe. So I think probably I don't have very much home bias. I think that can be a big problem. I think especially if you invest in a pension fund, I think often if you look at their allocations, I think the allocation to where you live is often far too high. And really you want general exposure to the world economy, which, I mean, and if you're in Ireland, you probably shouldn't have too much individual Irish stuff in there, because it's a very small part of the world. In fact, most of the very successful Irish companies really are very large international companies that happen to have headquarters in Ireland these days.
Yeah, that's a really good point. And look, I do know friends that had, say, Bank of Ireland shares back when the Celtic Tiger collapsed and the great financial crisis, and even Ryanair shares in the last 12 months or so with COVID has been interesting. So yeah, definitely been that impact. Yeah, I mean, I guess for myself, like I said, I kind of wanted to get access to a lot of the funds, the Vanguard funds, which has been really, really nice. So I have the S&P 500 and the All World. I have a little bit of small cap, but not too much exposure. And then there's a few REITs there and property funds that I like. I haven't yet, but I want to get into some investment trusts as well.
Yes, yeah, no, actually, that's the other thing I was going to mention, is that some of the stuff I said, especially last year, that I invested in. Investment trusts are a really interesting way to invest, because especially in market sell-offs, because actually you often get a double effect in investment trusts. And I don't know if we want to go into that now, but
no, but I mean, I guess yeah, there's discounts available within that fund, which is sometimes
So often the discount widens at a time of a market sell-off. So not only are you getting access to the market when at a low point, but you're getting into a bigger discount than you usually would. Yeah. So you kind of get a double effect when things recover.
Yeah, exactly. So yeah, but just try and be as diversified as I can.
Yeah.
But still being fairly aggressive because I know that there's a long time scale ahead of us, really.
Yeah, and if you look at investment trusts, you can get access to things that listed private equity or listed hedge funds that can be an interesting part to your portfolio as well.
Yeah, and they've got the longevity. They've been around as long as the stock market itself. In some cases, some of them are over 120 years old, which is really great. So yeah, Tim, I think we've answered all the questions, and I think it's been an okay job. So yeah, thank you so much for your time today. And any final thoughts that you might have?
No, just to think of it. I mean, you do, ultimately your pension is your responsibility, whether you like it or not, and you do have to make some decisions about it. Even if those decisions are just ignoring it, that's still a decision. So, and I think if you do have some interest in it, then managing it yourself, I think, can be a rewarding thing to do.
Brilliant. Well said, Tim. Thank you so much.
Yeah. Okay. Thanks, Michael. It's good to talk to you.
Thanks. Bye.